A foolish consistency is the hobgoblin of little minds, adored by little statesmen and philosophers and divines.
If a man does not keep pace with his companions, perhaps it is because he hears a different drummer. A different drummer.
And now, coming to you from dead center on your dial, welcome to Risk Parity Radio, where we explore alternatives in asset allocations for the do-it-yourself investor. Broadcasting to you now from the comfort of his easy chair, here is your host, Frank Vasquez.
Thank you, Mary, and welcome to Risk Parity Radio. If you have just stumbled in here, you will find that this podcast is kind of like a dive bar of personal finance and do-it-yourself investing.
Expect the unexpected.
It's a relatively small place. It's just me and Mary in here. And we only have a few mismatched bar stools and some easy chairs. We have no sponsors, we have no guests, and we have no expansion plans.
I don't think I'd like another job.
What we do have is a little free library of updated and unconflicted information for do-it-yourself investors.
Now, who's up for a trip to the library tomorrow?
So please enjoy our mostly cold beer served in cans and our coffee served in old chipped and cracked mugs, along with what our little free library has to offer. But now onward to episode 424. Today on Risk Parity Radio,
It's time for the grand unveiling of money!
which means it's time for our weekly portfolio reviews of the 8 sample portfolios you can find at www.riskparity.com on the portfolios page.
Looks like I picked the wrong week to quit amphetamines.
But before we get to that,
I'm intrigued by this, how you say, emails.
and
First off,
we have an email from Yangon.
And it's gone. Poof.
And Yangon writes,
Hi, Uncle Frank and Aunt Mary. Thank you for continuing to share your knowledge and wisdom. I was wondering if you could give a lecture on your favorite brokerage, Interactive Brokers, and its margin loan program to me and fellow listeners because I might have a gambling problem.
Unlike any schooling you've ever been through before. At times, you may feel that you have found the correct answer. I assure you that this is a total delusion on your part.
Well, you have a gambling problem!
A little backstory. I had about $200,000 in IBKR Pro account, which comprises mostly VTI and some small individual stocks in the beginning of the year, which gave me an access to $100,000 in margin loan without selling any stocks.
Ah, the sweet smell of an all-day sucker.
In February, a real estate purchase opportunity popped up in my local town, and on February 26, I took out about $90,000 in margin loan to make a cash offer, thinking that a 10% cushion would be enough to avoid margin calls.
1 minute you're up $500,000 in soybeans, and the next, boom, your kids don't go to college and they've repossessed your Bentley. Are you with me?
VTI was trading at $290 a share that day. Well, a lot has happened in the U.S. market in the following 2 months, with VTI bottomed out at $244 a share on April 8th so far in 2025. In those 2 months, my margin loan-to-value ratio went from 40+% of the portfolio value to 60+% loan-to-value of the portfolio. I thought the margin call was coming when I saw 0.00 in cash available for withdrawal, assuming margin loan, in my withdrawal screen. Luckily, looking at the year-to-date statement, there is no realized gain or losses, so my understanding is that no margin calls happen in April. Honestly, it's a bit of a lucky mystery to me. With that, here are my questions. 1. My understanding is that Interactive Brokers uses my stock portfolio as the collateral for taking out money with margin, just like a house is collateral for a mortgage. Is my understanding correct? 2. When do Interactive Brokers start selling my stocks? Did they have a specified percentage for margin loan to value that they start selling off my investment portfolio? How come I did not get the margin call on that day? Does that have anything to do with stocks having a huge comeback on April 9th? 3. In the monthly statement, I see an accrued interest, but I have not made any deposit yet. Is there a monthly minimum payment amount like credit card bills or monthly mortgage, or do they accrue until I pay it back or margin calls occur? 4. Do dividends and sales of stocks automatically go to pay off the balance, or does it get reinvested if you're set to reinvest? 5. I moved my assets from another brokerage to IBKR within the last year, and I know I have not explored all the features yet. Besides the margin loan rates and its presence in foreign countries, are there any other benefits for DIY risk parity style investors to hold long-term assets in Interactive Brokers? I have no interest in trading options or Forex. I know I asked a lot of questions. I just don't want to fly solo and need someone watching my back at all times. Thank you and have a great day. Yangon.
No more flying solo. You need somebody watching your back at all times.
Well, before we get to your questions, I wanted to thank you for being a donor to the Father McKenna Center. As most of you know, we do not have any sponsors on this podcast, but we do have a charity we support. It's called the Father McKenna Center, and it supports hungry and homeless people in Washington, D.C. Full disclosure, I'm on the board of the charity and am the current treasurer. But if you give to the charity, you get to go to the front of the email line, which is a couple months long now, so it may be worth it to you.
And I'll go ahead and make sure you get another copy of that memo. Okay?
And there are a couple ways to do that. First, you can go to the Father McKenna website itself on the donation page, which I'll link to in the show notes. Or you can go to the support page at www.riskpartyradio.com and sign up for Patreon and give that way. Either way, you'll get to go to the front of the email line.
That is the straight stuff, O Funkmaster.
Just make sure you let me know in your email that you have given to the charity. And either way, you'll get to go to the front of the email line as soon as my crack team finds your email.
We have top men working on it right now. Who? Top men.
Well, this is a very good series of questions about margin accounts and margin accounts at Interactive Brokers in particular, because this can be a very useful tool for a lot of people in their retirement scenarios, particularly if they have a large taxable account. So, addressing your questions in order, the first one is whether the stock portfolio you have acts like collateral for a mortgage for the margin account. And the answer is yes.
Yes!
And it includes whatever else you have in your account there. So it includes the bonds and all other assets that you might have there. And this is actually a reason you might not mind having some bonds or something that generates ordinary income in a taxable account. Because if you are paying margin interest, that interest is tax deductible or offset against the ordinary income generated by the account. And you use IRS Form 4952 to report that and take advantage of that. So any margin interest you pay can be tax deductible if you structure things in the right way.
That's the fact, Jack! That's the fact, Jack!
But yes, whatever is in that portfolio, in that account, is collateral for the margin loan. Your second question is, when would Interactive Brokers start selling your stocks? Well, the way a margin call works is if you exceed, or I should say, if you have not enough money in there to support the margin in the account, then you will get what is called a margin call. And Interactive Brokers will send you a message, and it will say, you have a margin call, and you need to either put some more money into this account to satisfy that, or we're going to sell some of your assets. And usually that occurs within a day or two's time. It's usually about a day.
You think anybody wants a roundhouse kick to the face while I'm wearing these bad boys? Forget about it.
But you have to be taking some serious margin at Interactive Brokers to trigger a margin call, because they do give you a very expanded margin level, which is usually several times the nominal account size. So the reason you did not get a margin call on April 9th is that you are not actually taking that much margin, given their limits there. And they do have some of the largest limits in the industry.
Oh, Mr. Marsh, don't worry. We can just transfer money from your account into a portfolio with your son, and it's gone!
Your third question is whether there is a monthly minimum payment on the accrued interest in the margin account. And the answer is no. That's not the way this works.
That's not how any of this works.
It's simply if you do not maintain enough collateral in the account to support what is being borrowed, you'll get a margin call. And they just keep adding the margin interest to that over time.
It's like you're unraveling a big cable knit sweater that someone keeps knitting and knitting and knitting and knitting and knitting and knitting and knitting.
So there are no minimum payments. Your fourth question was whether the dividends and sales of stocks automatically go off to pay off that balance. And the answer to that is yes, as a practical matter. Now, if you didn't have a margin account and you weren't taking any margin, that money would go into a settlement account, and it would just sit there and earn some interest. But if you are taking margin, that money is going to be first credited against the margin that you're taking, the loan that you're taking, before it would go into a settlement account. Now, whether it would get reinvested if you had set it to reinvest, I'm not sure. I think it still would. Basically, it would go into the margin account briefly and then get reinvested according to your instruction. And so you'd be taking the same amount of margin. But I've turned off all reinvestments for our accounts in retirement because it's inconvenient. It creates a number of other transactions. I'm probably going to be spending some of the money anyway, and then we can just use it to rebalance. So it's actually a big inconvenience to be having things reinvested in retirement if you're managing the account anyway and taking drawdowns. And your final question was whether there are any ancillary benefits to this, because you haven't explored all the features yet. And yes, there probably are, although I don't sit around comparing where you were before to where you are now. But Interactive Brokers is designed to be the lowest cost and most efficient brokerage for traders and people who run family offices, people who manage a lot of money. So basically, almost whatever is legal to be done in a brokerage account, you can do it at Interactive Brokers, and probably more efficiently than you can do it somewhere else. I know they do have trading platforms if you're interested in that, but a lot of the features of it are not that useful for somebody who's just managing a simple account and not trying to have a whole lot of transactions. Just a couple more comments on the margin accounts themselves. You can see what those are and what's going on in there. You shouldn't be waiting for your monthly statements if you have questions about this. You should just go log into your account or download their app and use that and look at your balances, and you can see there how much is in margin, how much you have available in margin before you would get a margin call, and all of that kind of data so that you can manage your account properly. So do not be waiting for monthly statements from there. Go in, log in there, and see what's there. I do find that the tax statements and other reports you can generate out of Interactive Brokers tend to be a whole lot more useful than something you might be able to get at, say, like Fidelity or something like that. Their 1099s are better structured. They give you 8849s. Hopefully I'm getting that number right for other transactions in there. They're good about telling you what qualifies for Section 1256 treatment as far as your taxes are concerned. And you can also generate a report that shows you when short-term gains are going to become long-term gains. And you can do that from the report section at the website. We've been using that as our primary taxable account since about 2013, I think. And they've been very helpful and have a lot of features that we frankly do not have any use for since we are not day traders or something like that. I will tell you one annoyance that I've had with them is that to donate shares out of my account there, I need to fill out a form for each one of those things and upload it, which seems kind of primitive in the era of the 2020s, although I know they just want to be careful to make sure that they aren't sending their clients' shares off to some scam artist.
Am I right or am I right or am I right? Right.
But as you can imagine, since we've held gold ETFs there for over a decade, and we like to do some charitable transactions, it is most convenient these days for us to donate shares in gold ETFs than anything else.
I love gold.
And take full credit for the deduction and avoid all of the taxes.
And that's the way, I like it.
And just one other note or observation, that it is actually very difficult to calculate what exactly the margin is going to be on a particular portfolio because it varies asset to asset depending on what kind of asset it is and its volatility. But that information is always reported and you can find quite easily in the balances section of the reports if you go to the Interactive Brokers website or use the app. But those are very good questions, and thank you for asking them because I think others who listen to this podcast probably have similar questions or wonderings.
You are talking about the nonsensical ravings of a lunatic mind.
So thank you for the support of the Father McKenna Center, and thank you for your email.
Bow to your sensei. Bow to your sensei! Second off,
we have an email from the Value Stock Geek.
Surely you can't be serious. I am serious. And don't call me Shirley.
And the Value Stock Geek writes,
Hey Frank, hope you're doing great. Quick one for you that might be useful for the audience. I hold gold ETFs in my taxable accounts and Schwab is my broker. This year, my 1099 was littered with a bunch of tiny distributions, nickel and dime stuff. These aren't even cash distributions. I think it's an odd way to account for expense ratios when the funds sell gold, which is apparently a monthly event now. I've held gold ETFs for years and never saw these charges on SGOL until this year. And with GLDM, I only got hit once before. To keep it simple, I just recorded them all as gains with a cost basis of 0. My annoyance with this is not about the money, as it's a very small amount. It's the hassle of manually entering a dozen tiny transactions on my tax return for each ETF in each taxable account.
What, guy in a suit? No! It's a tax collector! Hey there, SpongeBob!
So here's what I'm wondering. Are these annoying little distributions a Schwab thing? Or am I getting hit with them no matter where I go? Is there another broker I could use that wouldn't list all of these transactions on my 1099? Would love your take.
This is gold, Mr. Bond. All my life I've been in love with its color, its brilliance, its divine heaviness. I welcome any enterprise that will increase my stock.
Well, before we get started on your question here, and just in case listeners don't know, the Value Stock Geek has a nice blog, and he has a podcast called the Security Analysis Podcast that I have appeared on, but more importantly, Tyler from Portfolio Charts has appeared on, and I will see if I can link to that in the show notes. And he is the author or founder, if you will, of the Weird Portfolio, which is also featured at Portfolio Charts, if you want to check that out.
You're insane, gold member!
But he has been paying attention to us for a good number of years here, and we greatly appreciate his presence.
We few, we happy few, we band of brothers.
So yeah, I'm also dumbfounded by some of these things that appear on 1099s. And I do have the same issue with Fidelity's 1099s, where there's a series of de minimis transactions reported, which I can tell you my accountant effectively ignores and does this summary thing when he does the Schedule D and supplemental form reporting. But yeah, I think this is brokerage to brokerage because I don't get these sort of things on my 1099 from Interactive Brokers, for example. So I'm not sure what the de minimis level is and whether it's just a computer generating things out of these things. But yeah, I mean, these are like penny transactions that are reported on a monthly basis, and they make no sense to me at all.
I don't understand. I made a reservation. Do you have my reservation?
Yes, we do. Unfortunately, we ran out of cars.
But the reservation keeps the car here. That's why you have the reservation.
I know why we have reservations.
I don't think you do.
But yeah, if you do want to avoid them, I would move to Interactive Brokers. That's all I can tell you, because I've never had them report these kinds of transactions in my 1099s from Interactive Brokers.
Not going to do it. Wouldn't be prudent at this juncture.
Hopefully that helps, and thank you for your email.
Would you feel better if you knew one of my secrets? Or?
Don't gross me out.
No, we're not talking gross here. No, it's just embarrassing. This information cannot leave this room, okay? It would devastate my reputation as a dude.
No problem.
I've never bagged a babe. I'm not a stud. I got the rep in 6th grade, and it stuck with me. I'm still on hold. Look, I appreciate you not laughing at me, okay?
I'm sorry.
It's not what I meant.
Last off, we have an email from Graham.
Polly want a cracker.
And Graham writes,
Hi, Frank. I have gone back and listened to episode 7, where you talk about a spectrum of correlations with stocks on the right and long-term treasuries being on the left, making those two the core holdings of any risk parity style portfolio. But nowadays, the correlation between them is higher than before, positive, not negative. You've talked about BTAL before, and I was looking at that. It looks to be the new negative correlation champ. I know it's relatively new and tweaked in 2022, but do you think we should consider it a core instead of treasuries? How's your experience been holding it in the Risk Parity Ultimate portfolio? Here is a link to a recent correlation test comparing it with treasuries and the S&P. Graham.
Well, the short answer to your question is no. You should not consider BTAL as a substitute for treasury bonds. There are a couple reasons for that. We did analyze BTAL in detail back in episode 114. And just to remind people what it is, since we haven't talked about it in a while, BTAL is a long-short fund. And so it goes long value stocks and short growth stocks, which tends to actually give it about a zero return over time. So you are really using it as a hedge, if anything at all. I'll link to the Testfolio analysis since it came into being in about 2013, but the returns are essentially zero. Of course, during that time, we had growth stocks greatly outperform value stocks, and I'm sure it would look a whole lot different if you looked at it from the period of the year 2000 to the year 2010, and you'd think it was the greatest thing since sliced bread. But it is really a hedging strategy, whereas bonds you expect to have a positive return over time. Now, as to its negative correlation recently, yeah, it generally is negatively correlated with the stock market, whereas bonds are positively correlated sometimes and negatively correlated at other times. But I think it is folly and a form of market timing to be chasing changes in correlations, because correlations do change all the time, but they are primarily based on macroeconomic factors. Namely, is growth in the economy declining or is it increasing? And is inflation in the economy increasing or declining? Because what treasury bonds really represent in a portfolio is recession insurance.
You know, I got friends of mine who live and die by the actuarial tables, and I say, hey, it's all one big crapshoot anywho.
For those times when inflation is going down and growth is going down. So that's a 2008 scenario. The last time we saw that was early 2020. But you usually see it a couple times a decade. We have not really seen it since 2020, which leads people to believe that this time is different.
What he means is Old Testament, Mr. Mayor. Real wrath of God type stuff. Exactly.
But I assure you, the next time there's a recession, you will see negative correlation between treasury bonds and stocks spring back into form. And there's a nice paper that I've cited to several times. It's a very technical paper about stock market volatility and treasury bonds. But there is a nice figure in the appendices of it which shows the history of correlations between treasury bonds and the stock market going back to the 1950s. And what it shows you is basically every time there's a recession, the negative correlation springs back to life. And then in positive inflationary environments, you see more positive correlations between stocks and bonds. Correlations are not magical and they're not random, and they don't just show up and say, oh, this time it's different and we're in a new paradigm and now the correlations are going to be like this for so many years. That's not the way it works.
That's not how it works. That's not how any of this works.
The way it works is the assets are responding to the overall macroeconomic conditions in a probabilistic way. So it's not a certainty, it's a probability. So do not think for 1 minute that the correlations over the past 1 year, 3 years, 5 years, or even 10 years are necessarily going to tell you what the correlations between two assets are going to be in the future. The only really good information we have about that is knowing which of these assets perform well or poorly in these economic environments, as described by growth and inflation. So no, I don't think BTAL is going to be a substitute for treasury bonds because it does not appear to have a positive return over time, which treasury bonds do. And it is not clear or certain that it will have the insurance quality that treasury bonds do in a recessionary or depressionary environment, which is ultimately why you were holding them in the first place. And as to your final sub-questions, how was our experience in holding in the Risk Parity Ultimate portfolio? It's really kind of meh. I would say it's meh. It doesn't add a whole lot. It doesn't take away a whole lot. It looks good at some points in time, particularly when you saw the stock market declining this year. We used to hold some of it in our personal portfolio, but we got rid of it because it just didn't seem to be worth the space that it was taking up. So I don't think it's a bad idea, but I'm not sure it's a good enough idea for you to include it, and I would not consider it to be a substitute for treasury bonds in a portfolio.
That and a nickel get you a hot cup of jack squat.
Hopefully that helps, and thank you for your email.
Now we're going to do something extremely fun.
And the extremely fun thing we get to do now is our weekly portfolio reviews of the 8 sample portfolios you can find at www.riskparityradio.com on the portfolios page. And it was a fun week for most of the assets.
It's the happy, happy, joy, joy song. Happy, happy, joy, joy, happy, happy, joy, joy. Happy, happy, joy, joy, happy, happy, joy, joy. Happy, happy, joy, joy, happy, happy, joy, joy. Happy, happy, joy, joy, joy.
Looking at the markets, the S&P 500 represented by VOO is up 1.74% for the year. I haven't seen that since about February. The NASDAQ 100, represented by QQQ, is up 2.16% for the year. Small cap value, represented by the fund VIOV, is still the worst performer this year. It's down 8.49% for the year. followed by gold, which is still the best performer for the year, even though I think it had the worst week in about 6 months or so. Representative fund GLDM is up 21.64% for the year. Long-term treasury bonds, represented by the fund VGLT, continue to make us snooze. They are up 0.6% for the year. REITs, represented by the fund REET, are up 3.83% for the year. Commodities, represented by the fund PDBC, are down 1.92% for the year. Preferred shares, represented by the fund PFFV, are up 0.32% for the year. And managed futures are still managing to lag. Representative fund DBMF is down 3.03% for the year. Moving to these portfolios, these sample portfolios. First one's a reference portfolio called the All Seasons. It's only 30% in stocks. It's got 55% in intermediate and long-term treasury bonds, and the remaining 15% in gold and commodities. It's up 0.6% month to date. It's up 2.32% year to date, and up 11.51% since inception in July 2020. Moving to the bread and butter portfolios. First one's Golden Butterfly. This one's 40% in stocks, divided into a total stock market fund and a small cap value fund. 40% in treasury bonds, divided into long and short, and the remaining 20% in gold. It's up 1.23% for the month of May. It's up 3.55% year to date, and up 38.68% since inception in July 2020. Next one's Golden Ratio. This one is 42% in stocks, in a large cap growth fund and a small cap value fund. 26% in long-term treasury bonds, 16% in gold, 10% in managed futures, and 6% in cash and a money market. It's up 2.02% month to date. It's up 2.14% year to date, and up 32.74% since inception in July 2020. Moving to this kitchen sink portfolio, the Risk Parity Ultimate. This one has some BTAL in it.
What?
But I'm not going to go through all 14 of these funds. It is up 1.81% for the month of May. It's up 2.14% year to date, and up 22.07% since inception in July 2020. Now moving to these experimental portfolios, which all involve levered funds. Don't try this at home.
You have a gambling problem.
First one's the Accelerated Permanent Portfolio. This one is 27.5% in a levered bond fund TMF, 25% in a levered stock fund UPRO, 25% in PFFV, a preferred shares fund, and 22.5% in gold. It's up 0.3% for the month of May. It's up 1.93% year to date, and up 2.98% since inception in July 2020. I thought we were going to have a rebalancing here, but since the stock market recovered, we are out of rebalancing territory. We do look at these on the 15th of each month to determine whether they should be rebalanced or not, at least these experimental ones. Next one's the aggressive 50-50. This is the least diversified and most levered of these portfolios, and the worst performer by far. It is essentially 1/2 stocks and 1/2 bonds, but it's got 33% in a levered stock fund at UPRO, 33% in a levered bond fund TMF, and the remaining third divided into a preferred shares fund and an intermediate treasury bond fund. It is up 2.4% for the month of May. It's down 3.65% year to date, and down 15.14% since inception in July 2020. Moving to the levered golden ratio, this one's a year younger than the other ones. It has 35% in a composite levered fund called NTSX. That's the S&P 500 and Treasury bonds, levered up 1.5 to 1. 20% in gold, GLDM. 15% in a international small cap value fund, AVDV. 10% in KMLM, which is a managed futures fund. 10% in a levered bond fund, TMF. And the remaining 10% in two levered funds, UTSL, which follows utilities, and UDOW, which follows the Dow. It's up 1.88% month to date. It's up 4.39% year to date, but down 0.22% since inception in July 2021. And the last one is our newest one, the Optra portfolio, a return-stacked portfolio, one portfolio to rule them all. It has 16% in a levered stock fund UPRO, 24% in a worldwide value fund called AVGV, 24% in GOVZ, which is a Treasury strips fund, and the remaining 36% divided into gold and managed futures. It's up 2.84% month to date, it's up 2.63% year to date, and up 5.62% since inception in July 2024. Still not a year old yet. And that concludes our weekly portfolio reviews.
Boring!
A much pleasanter week than many this year so far.
Oh, how convenient!
And what will next week hold? Well, we can ask our crystal ball.
My name's Sonia. I'm going to be showing you the crystal ball and how to use it, or how I use it.
What does our crystal ball always tell us about what's going to happen in the future?
We don't know. What do we know? You don't know. I don't know. Nobody knows.
And so once again, we have the same reading.
That's not an improvement.
But now I see our signal is beginning to fade. If you have comments or questions for me, please send them to frank@riskparityradio.com. That email is frank@riskparityradio.com. Or you can go to the website, www.riskparityradio.com, put your message into the contact form, and I'll get it all that way. If you haven't had a chance to do it, please go to your favorite podcast provider and subscribe, give me some stars, a follow, a review.
That would be great. Okay.
Thank you once again for tuning in. This is Frank Vasquez with Risk Parity Radio, signing off.
The little critters of nature, they don't know that they're ugly. That's very funny. A fly marrying a bumblebee. I told you I'd shoot, but you didn't believe me. Why didn't you believe me? Happy, happy, joy, joy, happy, happy, joy, joy, happy, happy, joy, joy, happy, happy, joy, happy, happy, joy, joy, happy, happy, joy, joy, happy, 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 joy, joy, joy.
The Risk Parity Radio Show is hosted by Frank Vasquez. The content provided is for entertainment and informational purposes only and does not constitute financial, investment, tax, or legal advice. Please consult with your own advisors before taking any actions based on any information you have heard here, making sure to take into account your own personal circumstances.